Imagine this. The global economy is shifting like tectonic plates under the surface, but unlike earthquakes, these shifts are not sudden. They're slow, powerful, and transformative. But how will they impact you as an investor? How do you make sure your portfolio not only survives, but thrives in this changing landscape? Welcome back to our channel. Today we're diving deep into one of the most critical yet subtle transformations happening in global finance today, the shift in global economies. Deglobalization, shifting trade alliances, and changing economic policies are more than just headlines. They're real trends that can shape your investments and long-term wealth. So let's get straight to it. How can we, as investors, adapt our strategies to navigate these changes and capitalize on new opportunities? We're living through one of the most complex economic environments in modern history. After decades of increased globalization, the world is now witnessing a slow pivot towards deglobalization and regionalization. The COVID-19 pandemic, followed by geopolitical tensions and trade wars, exposed vulnerabilities in global supply chains, prompting countries to reconsider their economic dependencies. Our key questions for today. 1. What does this economic shift mean for investors like us? 2. How can we adapt our investment strategies to stay resilient and capture growth? Deglobalization. It sounds daunting, but what does it really mean? For decades, globalization helped companies access cheaper labor, materials, and new markets, creating a tightly interwoven global economy. But now, driven by trade conflicts, national security concerns, and self-reliance movements, countries are starting to decouple from this system. One of the most significant examples is the trade tensions between the U.S. and China. Now, after re-election of President Donald Trump, tariffs are expected to increase. Increased tariffs, export restrictions on technology, and security concerns have forced companies to rethink their global strategies, affecting everything from tech to manufacturing. The direct impact? Companies like Apple, which heavily relies on China for its supply chain, are now exploring alternative production hubs like India and Vietnam. So, as an investor, how do you protect your portfolio when giants like Apple or Tesla are making these shifts? How can we prepare for a world where supply chains and profit margins are in constant flux? Countries are realigning their trade partners, leading to a more regional approach to trade. This friend-shoring concept, where countries prefer trading with politically aligned nations, is reshaping markets. The European Union, heavily reliant on Russian energy in the past, has now pivoted to diversify its energy sources. This shift isn't just a reaction to immediate pressures, but a long-term strategy to secure stable energy and economic independence. Investments in renewable energy, energy storage, and infrastructure have spiked across Europe. For investors, this transition presents both challenges and opportunities. The winners in this scenario? Companies involved in energy transition technologies like solar, wind, and battery storage, which are critical as countries aim to become energy independent. However, beware of blindly picking stocks in these trending hot sectors. Always focus on buying quality companies with strong balance sheets, offering growth at reasonable valuation. Across the globe, countries are promoting policies to boost domestic industries and reduce reliance on foreign markets. Example, India's Atmanirbhar Bharat initiative. India has been vocal about its ambitions to boost domestic production across various sectors, from defense to technology. The government's push towards self-reliance through incentives and production-linked schemes has led multinational companies to establish and expand their operations in India. Think about Tesla's announcement to set up manufacturing in India, or Apple's recent move to expand production in India for its iPhones. For investors, This indicates a potential shift in tech and manufacturing stocks' global footprint. If you're invested in global tech or manufacturing, consider the growth trajectory of companies investing in countries with self-reliance policies, as they're positioned to benefit from local market protection and incentives. Let's discuss actionable strategies you can consider to adapt your portfolio. 1. Diversify geographically and sectorally. In a world where one region's downturn can create opportunities in another, diversification is paramount. Consider balancing your portfolio with exposure to economies that are thriving in this new environment. Did you know that while U.S. tech stocks have shown volatility, sectors like emerging markets, infrastructure, and energy have consistently been top performers? 2. Focus on sectors poised for growth, but yet available at reasonable valuations. Renewable energy, cybersecurity, and manufacturing are three areas seeing substantial growth and resilience amid global shifts. Companies involved in these sectors tend to benefit from both national investment and consumer demand. The global renewable energy market is projected to reach over $1 trillion by 2030, making it a compelling space for long-term investments. 3. Consider alternative investments. As traditional stocks and bonds experience fluctuations due to geopolitical tensions, alternatives like real estate, commodities, and even digital assets can offer potential stability and reduce portfolio-level volatility. Look at sectors like real estate investment trusts focusing on warehousing, as the demand for localized supply chains will keep warehousing assets in high demand globally. Stay liquid. Stay flexible. The flexibility to pivot your investments as conditions change is essential. A portion of your portfolio should remain liquid to quickly capitalize on new opportunities or hedge against unforeseen risks. Imagine you have liquidity ready when share prices in a high-growth sector plummet because of sentimental reasons. You could seize such opportunities if you always maintain some liquidity. Key risks to watch out for. Currency risks. With countries adopting protectionist policies, currency volatility could become more frequent. Investing in companies with less exposure to currency fluctuations could protect against unforeseen losses. Political risks. As countries move toward economic nationalism, political decisions can heavily influence markets. Stay informed about global political developments that could impact your investments. Supply chain disruptions. Companies are still realigning their supply chains, which could lead to delays or added costs affecting profit margins. These are just few risks we have discussed, and equity investing is fraught with unforeseen risks. So always focus on asset allocation and diversification. So, where do we go from here? While globalization won't end entirely, it's clear that countries and companies alike are rethinking their approaches. This pivot toward a more regional and resilient economy will shape the investment landscape for years to come. Adaptability is the key. Instead of fearing change, embrace it by building a portfolio that aligns with these new economic shifts. By focusing on sectors and regions set to benefit from regionalization, prioritizing diversification, and staying nimble, you can position yourself for both stability and growth. The world's economic landscape is shifting under our feet, and as investors, we have two choices. Wait for the dust to settle, or make moves now to align ourselves with the emerging opportunities. We hope this video has equipped you with valuable insights to prepare for this changing global economy. Remember, informed investing is empowered investing. If you found this video helpful, give it a thumbs up, subscribe for more, and share it with fellow investors who could benefit from this knowledge. Thank you for watching. For a one-to-one discussion with a highly experienced finance professional who always keeps your interest ahead of everything, You can write to us at info@eacapital.in, and one of our team members will get in touch with you.